Hey everybody, welcome to another episode of The Everyday Trader. This is Greg Jensen, CEO of Options Animal. Good to be with you again. Uh, Joined by my friend and partner, Eric Hale. How are you today?
I'm a little bit beaten up in case you didn't notice. So,
Well, that's what happens when are you Irish, by the way? Is that, did you,
mostly Scottish and English, but yeah, in the
okay.
mix.
Maybe I thought, went to the bar and had a few drinks with the buddies and turned into,
Yeah, and I bumped into the wall. No, I do jujitsu. I'm a purple belt, and I rolled yesterday with somebody in their 20s who was very aggressive. And I did not tap, but I did come away a little bit bruised, and it's okay though.
okay,
So,
that's good.
people don't mess with you when they say, "Oh, that guy." I'm not gonna. Maybe they do. I don't know. Maybe people want to mess with you, but bring it. I encourage you. Bring
Bring
it.
it.
We'll
Yeah.
see how that goes for you.
Well, we wanted to get together today and talk a little bit about the downgrade of our U.S. debt. The last of the agencies actually to do it, ironically, S&P downgraded the U.S. AAA rating uh, 15 years or 14 years ago in 2011. Fitch downgraded us in 2023, and then Moody's just recently, just a couple of weeks ago. And there's a couple of concerns, I guess, as to what this may imply for investments, as there are sometimes rules in regards to AAA rated bonds. And now that the US debt is no longer a AAA rated bond, then what does it pose? And we'll get to that in just a minute. But real quick, I'll just citing Moody's, they lowered our sovereign credit rating from AAA to AA1. Their concerns were the ballooning $36 trillion federal debt, rising interest costs, and unsustainable fiscal deficits projected to reach 134% of GDP over the next decade. Um, we do have, obviously, Moody's cited their concern about the political gridlock, the potential proposed tax cuts that got passed today, the day we're recording this, actually, at least,
Well,
but
they only passed the House. They got to
yeah,
still
they just
pass the
passed the
Senate.
House today. Now it's getting sent to the Senate, and didn't pass the House with as big of a margin as some people thought. Fiscal, I love personally, I love Thomas Massey. He was one of the guys,
You
he
know,
was one
he's
of the
one of my
Republicans that
favorites.
voted against it. But anyhow, those are the reasoning as to why Moody's finally lowered our debt rating from AAA down to AA. Um, but I guess the biggest question is, what does that do for the markets? What does it do for the economy? Does it pose risk for standard 60/40 stock bond portfolios? What does it do to interest rates right now? And I think those are some of the concerns that I think we as everyday traders, as investors, have to be looking at and trying to identify as to what kind of risk that imposes. So, what are your thoughts on that? What's it mean?
Yeah, there's a couple different aspects or areas where we should talk about. One is, your question is, what does it mean to our traders or everyday traders, people who are listening, and that is, first of all, we're seeing Treasury yields, especially in the long end of the curve. These are the 30-year bonds, and you can see this is a max chart here. So we're getting up towards almost 5%. That's 30 years. Here's 20 years again. So high. This is a long-term chart. This is going back, to 64, I think. The shorter term end of the curve is still not as high, and that's good. We used to have an inverted yield curve where the front end was higher than the back end, and we've got the back end. But this is what people are freaking out about is how high. These are subtle numbers. If you look, this is 4.2 to 5. That's not a big range. It looks more dramatic on this yield curve chart. So we get the back end of the chart going higher. We got this weird, it looks more like a duck, if you ask me. This part of the curve, the middle of the curve between the 6 month and the 7 year and the 10 year, we ideally would like to see a curve where those are higher as well. So there's some interesting things in the market. So you tie up your money for 5 years, or I'm sorry, not for 5 years, for 20 or 30 years, and you can lock in a rate close to 5%. It's so for some folks, it's is it worth it to get 5% a year, take my money off the take my risk off the table? So for some folks, it's going to make sense to say, listen, at some point, I'm better off. I think if we saw this middle end of the yield curve in here, this 2 year, 3 year, 5 year, 10 year, 7 years started getting much higher, we have serious concerns about what's going to happen with the S&P 500 because people will start pulling their money out of the S&P 500. And these numbers here, we talked in December about Goldman Sachs talking about a 3% annualized return for the next decade for people who invested in the S&P 500. So if you're serious, you think that's the numbers you're going to get over that period of time, maybe it makes sense now to put your money in treasuries. So that's one dynamic, is that it's bad for the market in that standpoint. Is there's a couple other things that matter as well. Probably the second one is, well, there's the question that always comes up when we talk about these sort of numbers is the fact that the United States currency is the reserve world currency, and anything that challenges the what do you call it, the liquidity, or no, the solvency of the United States debt. Now, I don't think anybody really thinks the United States isn't going to be paying its debt. Like that's,
Right.
uh, and there's 11 countries right now that have AAA rated, that are higher than us. But in terms of the size of those markets, they're small. But we saw the market yesterday react kind of freaked out, and the word was that there was a bad Treasury auction, and what it was a lack of buyers showing up to buy. So that's the third aspect is the market for people who are going to buy long-term treasuries, or people who are going to buy any sort of treasuries. And has that fundamentally been shifted? I don't know if you want to talk about that right away, or do you want to talk about the other two items? But I do. That's a big one that I think people really who are listening need to hear, this potential impact with the covenants thing that I talked to you about before.
Well, yeah, that's really, I think, where the issue is in a lot of standardized portfolios, and whether it's cash portfolios or cash equivalent portfolios, in some cases that they have it in cash or similar type of assets. A lot of times those similar assets are AAA rated bonds. And if you've got money sitting in what used to be a AAA, or yeah, it was in a portfolio basically being managed, and whether this is a interest bearing savings account at your bank, or whether it's an interest bearing account at your brokerage firm when they sweep money to cash. A lot of times what they'll put that money into is AAA rated bonds. Well, now the US Treasury bonds are not part of that mix anymore. Because if that's what the covenants say, that they have to be a AAA rated or equivalent type of asset, whereas they have been for decades. And so there's some question about how much money, how big of that marketplace exists, and then whether the companies that have those portfolios of US Treasury bonds that are supposed to be AAA rated based on their covenants, the question is, what will they do? Will they go through the effort of changing their covenants that allows them to still hang on to US debt? Because I agree with you. I don't think it's any question that the Treasury will just print more money. The Fed will just print more money if they need to keep making their debt payments. Um,
Which is not good for inflation, but
yeah, which is not good for inflation, good for gold prices, good for Bitcoin if
if
it
for
does that,
Bitcoin,
right?
all-time highs. Congratulations, Bitcoin.
Yeah.
I
But
want to reiterate what you said. I want to hit it again so
okay.
people heard this. So I first heard about this in December when I went to the College of Central Bankers annual monetary symposium in Manhattan. It was actually um, it was a dinner at the New York Athletic Club, and Mark Zandi is the chief economist for Moody's. spoke. And at the dinner, he said, "Hey, listen, folks, don't want to freak you out, but we just announced that U.S. or recently announced that U.S. was on debt downgrade. So AAA rating, we're the last agency to have a AAA rating, and it was due to the shenanigans that were happening, potentially shutting down the government, which had real tangible impacts. We had David Kotok at an event here in March, and David pointed out this is really a little bit arcane, but if you looked at U.S. debt collateralized in euros, it's a huge market. I mean, it's $1 trillion market, more than trillions of dollars. And this is people who buy insurance against U.S. debt. This is what a CDO is. And you could see the prices of U.S. insurance make dramatic, major changes in these markets when the stuff that was happening. And he's got a chart that goes through. Marjorie Taylor Greene spoke here, and so you could definitely see this chart in real time how the market was responding. And most Americans aren't aware of it. It's not even data we look at. But here's another tangible example of it is this Moody's thing. And what Mark Zandi brought up was that, hey, just so everybody in the room is clear, there are certain entities out there that some endowments or other investment entities that have a requirement, as you say, a cash requirement. In fact, you and I were negotiating a contract with another entity that told us that we needed to put $1 million in a bank account. And I'm like, well, what do you mean $1 million? And they said, well, you can put it in treasuries. And I don't remember what was in the contract because that was a few years ago. But my guess is it probably didn't say treasuries. It probably said AAA rated debt. And just in order to keep it broad, so they didn't want to say, hey, you have to do treasuries. You could do anything AAA rated. Now that contract today, now if it's rated AAA, now so we say, oh, we're going to put our money in treasuries, and then now all of a sudden we're in violation of the contract because it's no longer AAA rated. Now, as you mentioned, the covenants that are out there, does it make sense to rewrite the covenants, which is probably some entities would do. And you and I have a good friend who's a CIO. He does outsource CIO, Bill Kennedy for Risk Bridge. Bill is a CIO. So CIO makes, he gives you Risk Bridge pen. There you go. Bill Kennedy, yay. So a CIO is going to make 200, 300,000 a year or something like that. And there's some endowments that can't afford a full-time CIO. So Bill's company provides CIOs on sort of sometimes secondary CIOs. And I asked Bill about it in February. I said, how big is this thing? Because he was at the same meeting I was at in December. He said, it's huge. It's big. And I said, well, what's the situation with your clients? And he says, we're going through all of our clients and rewriting the covenants, rewriting the contracts. So this is a thing that I don't have an answer, and I don't even know how you figure out. Actually, I had a reporter call me on Sunday to talk about this, and he was, because I was at a bell ringing for the CBOE, and he was mentioning, oh yeah, I'm interviewing Mark Zandi next week. So hey, oh, Mark Zandi, we talked to Mark Zandi, talked to him about this debt downgrade thing, and so then he reached out to me on Sunday and said, hey, what was your concern again? I said, well, you've got all these endowments and other entities, and that it's contract required that they keep money in AAA rated debt. So he said, if the market goes down on Monday, I'll call you back and I'll quote you. And I said, listen, just because the market doesn't react, that doesn't mean this is a problem. He said, well, maybe, well, look, then he had this debate. Well, what should happen to bond yields? Should bond yields go up or bond yields go down? And what we've seen is bond yields spike this week, go up. So that was what would be an indication that there's a problem. So we're clear, people, a bond yield going up means the price of bonds went down, which means nobody wants to buy the bonds or people are selling them. It means there's selling pressure on bonds when bond yields go up because you get the same amount of money. The question is, how much do you pay to get the bond? So if the bond price goes down, your bond yield goes up. So you see bond yields going up means less demand for treasuries. And I reminded him because do you remember what it was like during COVID when, do you remember it was late January, early February? We had already lost China, right? So China was shut down. We weren't letting planes from China land in the United States. And Italy shut down first. And the S&P 500 was cruising higher. You and I were like, wait a minute. Is this virus like somehow geo-fenced, like it can't cross the border or something like that?
Yeah.
because it's literally shutting down countries. And we were seeing it happen. But so just because the market hasn't reacted, and there's this right now, there's this thing, and I'm going to tell you, my hackles are up, my radar, my spidey sense is peaking right now. That out of the market feels a little weird to me. What about you?
Yeah, no, it's a signal that I think the biggest issue right now is a potential risk of the supply demand for bonds. I mean, the bond market, and I'm sure many of you who are watching us know this, but some of you may not. The bond market in a monetary size dwarfs the S&P 500, the equity markets. It is enormous. There's an enormous amount of capital, and it's usually referred to as the smart money.
Wait, wait,
Uh,
wait, wait. You said the bond market dwarfs the S&P 500, or
yeah.
so the S&P 500 is peanuts compared to the
Yes.
right.
Yes. The S&P is
Well,
tiny.
how much outstanding treasury is there? Isn't there like 30
Trillion.
something,
Yeah.
36 trillion or something
36
outstanding
trillion,
treasuries?
something like that. And that's just our debt, right?
Yeah.
Um, that's not what you were referring to of
Right. That's not
the
the
swap
secondary,
markets.
the derivatives that are on there, which is, easily trillions of dollars as well.
So there's a lot of money in the bond market. And normally there's huge supply and demand going back and forth. And it's because it's been AAA rated for the longest time. We have been the most secure house in the world, the most liquid house in the world. And we're the world reserve currency. And so people do their transactions in dollars. And the supply demand issue is probably the biggest issue. And that's, I think, what you were saying is that you would think that with our debt downgrade that maybe you see bonds decrease in value because people see, hey, maybe I'm worried I should maybe, but we're seeing the opposite. We're seeing people selling bonds and rates spiking, and that tells me that it's not just people redoing their covenants. It does tell me that there are some investment houses right now, whether they're local, whether they're international, probably a combination of both, who are looking at their 60/40 bond portfolio that have covenants that say, yeah, we can only own AAA rated bonds. Maybe this is the excuse they've been looking for to say, we're going to start selling US bonds. And the supply demand equation is a little bit tipped right now. Ray Dalio had an interesting piece today where he talked about that. And he said, we should be very concerned about the bond market. We need to be paying attention to the bond market. But again, as investors, specifically, stock focused investors, most of us, is we have a tendency to just look at the S&P 500 and we look at the Mag 7 and we say, oh, Nvidia's doing fine. I'm great. Tesla's great. It's up today. Tesla actually had a pretty nice day today, to bring up one of yours. Um, but so yeah, I'm kind of the same way as you are right now. I don't want to say let's throw in the towel and short the world economy, but I do agree with you that there's something right now that the market feels out of balance after this down. It doesn't feel like the market absorbed it how it should have. I guess is maybe what I'm saying is that maybe there should have been a little more shock, which maybe tells me that the shock hasn't happened yet. And we're still waiting to see with that debt downgrade where the chips are going to fall. And we could see some momentum one way or the other. It could be to the upside, to be quite honest. We could see the S&P just rip right now. Um,
Yeah, this is the thing. I feel like we're at some sort of influx here. I don't know where this thing's gonna go. It just, like I said, my spidey sense is peaking. That there's a great disturbance in the force right now in that market, because it is a great market. We're not seeing it. The VIX has just dropped down. It's almost under 20 today. The move index, which is a bond index, is, it's a little bit elevated. It operates on different numbers, but I can pull up a chart of the VIX of the move index. So it's sometimes referred to as um, the VIX of bonds. Now, there are some caveats. I think it was Bassman. There's a Harvey Bassman who came up with the move index. There's some limitations about this index, and I don't know that it really reflects actual volatility. There's some things that are potentially missing here, but anyways, it's still somewhat elevated. That's the move index. Oh, sorry. That's the move index, and we can go back a couple slides here and see the VIX. That's the move index, and no, one more in the VIX. One more. That's the VIX. Yeah. So that's there's a 1 year chart of the VIX. Yeah. The other thing is we look back at this spike. This spike sticks out. Remember that was the Japanese carry trade unwinding, which our friend Michael Guyed still screaming about Japan and the story's not over, using R-rated language. If you listen to follow him, yeah, I think there's still some anxiety that's existing in the marketplace. I'm more concerned about this, this covenant thing and how that would potentially play out. And I think it's going to be a slow moving thing. It's not going to be an overnight thing because we don't have the reporter that I was speaking to was asking me like, well, how big is the bread box? Well, that was in his words, my words, but he's like, well, how big is that? How much money is there that's tied up in these contracts? And so we don't really know. I don't even know how we were trying to brainstorm, like, how would you find out? And that's what I told him is, you call an outsourced CIO or somebody and they can give you a feel and maybe you can try to extrapolate to get an idea of how big of a problem it is. But this is one of those things that I don't think is on many people's radar. On the other hand, Bianco over the weekend, when he knew, Moody's downgraded on Friday. So over the weekend, he was tweeting. He specifically said this covenant thing is a nothing burger, I think is what he said. So I hope he's right. I hope he's right.
I
But
hope he's right too.
yeah,
I have seen the Fed kind of slow down in the last few weeks. Their QT. A lot of people aren't aware that they've still been letting their balance sheet diminish. They haven't touched their I want to have a conversation again. I'm gonna actually maybe I'll bring that up in Jackson Hole with Lockhart. I think Lockhart's going to be in Jackson Hole here in a couple months. Um,
Plosser and Lockhart, I think.
oh, that's right. Plosser will tell me. He's been gone long enough. He'll have an opinion. Lockhart will too, I think.
They'll
The
both
question I'm
tell
going
me
to
about it.
ask, number one, is you can see that curve. It had been sloping pretty hard to the downside. They've been letting their portfolio unwind, but it's starting to flatten out a little bit. I think they're slowing down because of the tax bill, because of the downgrade. I think they may be, um, I don't know that they're necessarily in the bond market buying again and increasing their balance sheet, but they're not a seller right now. I've noticed the last few weeks they've kind of tapered off a little bit. But what would be interesting is to have a conversation with them again about their mortgage-backed securities that are on their books. I think somewhere in the neighborhood of about $3 trillion of that number are actually mortgages that are on the books. And I remember when we had that conversation with Waller, he was very adamantly not going to talk about it.
He doesn't think, well, not going to put words in his mouth, but I don't think thinks the Fed should have any treasuries on the books. By the way, did you see Trump's tweet about Fannie and Freddie?
No, I
He
missed it.
says he thinks we should privatize them.
Oh, geez.
Yeah. So hopefully when we go to Camp Kotak, we'll see Bill Duncan, who's he's the chief economist for one of the two. I always get the two confused. So he's like, that's okay. I think it might be
Yeah.
Fannie Mae. Uh, you know Bill Duncan, right?
Yeah. 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 Bill's a good guy.
Yeah. Really good guy.
I don't know if I didn't fish with Bill. I fished with an oil guy last time. That was the
Jim
guy that,
Steves.
yes. Yes. That guy.
Yeah.
I liked him.
Yeah. Jim and I were talking, and he was talking about what's the what's the emergency petroleum reserve
The
we have right now?
Strategic Petroleum Reserve.
Strategic Petroleum Reserve. He made some comments about the Strategic Petroleum Reserve, and I'm like, I don't think that's right. I think it's, and he's like, I know it's right. And I was like, no, I think it's, and he's, well, I used to work for the Department of Energy and I ran the Strategic Petroleum Reserve. I was like, oh, I guess you would know then. He's like, yeah, yeah, I was responsible for maintaining it. Oh, okay. Good times. Yeah.
Well, we will wait and see. I think right now it still remains a good time to it's a good time to still be invested. There's volatility doesn't mean go away. Volatility just means you have to be on your toes. You have to understand your exit points. You have to understand your risk. But it does create opportunity, especially in the options market, if you understand how to combine trades. So, I know we talk big picture stuff sometimes in this program, particularly because we like to talk about economics, because I think you and I are both nerds at heart. But other than you're a nerd that likes to roll around on the mat and punch people.
There's no punching. There
Oh
is
yeah,
lots of choking and arm
strangleholds.
bars, joint locks, things like that. But I don't punch anybody.
You're a different kind of nerd.
Eh,
You're a different level nerd.
I'll embrace that. Hey, let's do some. Let me throw a curveball at you.
All right.
So for our people who have patient enough to stick around to the end, you got any hot stock tips? Everybody wants a stock to watch. You got anything you're watching?
I'm still sticking with the one I brought up a couple weeks ago when we did our 10-year ones.
Rocket Lab.
I'm actually in a trade on Rocket Lab right now. Yeah, Rocket Lab. Um, that's had a nice move the last couple of weeks since they had a successful launch with one of their new bigger rockets, and they're heading back towards all-time highs, low 30s right now. We'll see if they get up there. I'm in a pretty conservative trade personally, but this is a stock I plan on trading a lot over the next decade. Like I said, I think this is a stock that's been fun. Another one I'm in right now is Dell Computer.
Me
Uh,
too.
got a position on Dell. Um, Again, here's a stock I think is positioned well to continue to benefit from the build out of the AI um, mega servers that are going to continue to have to grow at the rate they're growing. By the way, I'm going to throw another curveball at you. I know you threw
I know
stocks.
what you're gonna say.
Did you see the interview
Oh,
by Eric Schmidt
no, okay. I thought you were
about?
going to talk about the Johnny Ive and Sam Altman thing.
Oh no, but that's kind of down along kind of the same lines. That's actually a great example of so Eric Schmidt. You need to go find it. You remember Eric Schmidt, right?
I know who he is. Yeah, yeah.
Used to be
Check
the CEO
Google.
of Google. He made a comment that, and it was like 2020. He said by 2027
Oh, yeah.
that there will be an AI computer that will be smarter than humankind combined.
Yeah, well, yeah. Ray
That's like,
Kurzweil has talked about this thing called the singularity, where humans and computers cross. And if you listen to Rogan, it's on Rogan's radar that AI may be a new form of life. Have you watched this news on Apple TV, Murderbot?
no.
It's got Skarsgård with Alexander Skarsgård. One of the Skarsgårds is on it,
Okay.
and he plays this AI robot. And these sort of hippie space people take, and they need to get insurance, and they have to take a security bot with them. And it turns out the security bot is sentient, and these people have a moral objection to forcing sentient people to work because they think it's slavery, which is really interesting. When something becomes sentient and has its own thoughts and emotions, is it life? It's an
Is it live?
incredible sort of
Yeah.
thing to sort of debate. It's very interesting. And that's, you know, this is the whole reason. This is Skynet, right? This is how
Yeah, exactly.
Terminator came about.
This is
Uh,
Skynet or whatever it was called in the Matrix before it became the Matrix, right?
Sam Altman says we're on the cusp of the greatest innovation in technology history. Uh, that's a pretty bold statement. I don't know what I go with that, but it is a major, where we're at right now is going to be a major. on a timeline, there's going to be this is where AI was introduced. And it's just amazing how much it's changed over the past. I mean, I was using ChatGPT just 6 months ago, and it's so much different now. And all of this enabled, by the way. We had Barry on a while. So our friend Barry, the Silicon Valley expert insider, talking about it's all enabled by the acceleration and computing power, which isn't slowing down. So
No.
we are at the worst that AI is ever going to be right now. And you think about a year ago, these videos. You remember the videos of what's his name, Will Smith eating spaghetti? How
Yeah.
disturbing that! And now the videos are almost indistinguishable from film. And it's just Google is accelerating. Google's got a really good. They
You
had
may have
their
heard me chuckle, just as an example. You may have heard me chuckle when you were talking about we were talking about the bonds, and I was on Twitter, searched up Zero Hedge, posted an article about a mystery buyer showed up today in the bond market right after the bill passed that kind of stabilized the bond market a little bit today. Actually caused yields
the
to
bond vigil. No, those aren't bond vigilantes.
well,
Those are
the mystery buyer, someone was quick enough within like seconds to create an AI image of Jay Powell at a keyboard. Here's your mystery buyer, and
yeah,
it's a really good image of him.
yeah, for sure. Do you know that Buffett owns 7% of all outstanding treasuries? Buffett, 7% of all US treasuries. One guy, one
One
company.
guy.
So my stock pick for you folks, Google, they had a major product release. This is a nice trade. It's already too late, but our traders at Trader Oasis got this one yesterday. So if they were timely, it was a very nice move, $24 move on Snow. But I'll show you one that I think is worth looking at, and that's Novo Nordisk. We are near just off 52-week lows. Goldman Sachs just published a really glowing report. They got a price target like 120, I think, which is pretty reasonable. This is still the GLP-1 agonist products, which we had another guest on. We had Ari, Dr. Ari, who's a weight loss certified weight loss medical doctor. Really bullish on the things that we've lost a lot of the momentum on the GLP-1s, but this is certainly a company that has, look at a PE of 20. They've got decent earnings. I think you could do worse. They've got great liquidity. All right. That's that call that I blew off.
There you
Yeah.
go.
All right. So you want to wrap this up?
Yeah, well, thanks for joining us, folks. Don't forget to share this with your investing friends.
Okay.
Like and subscribe.
All right.
Um,
We'll talk to
any,
y'all soon.
all
Thanks,
right.
everybody.
Thanks.
See ya.